All right, now we're going to look at personal property and look at the modifying convention, which is an adjustment to the depreciation deduction, remember, in the first year and in a year of disposition. Exactly the same concept as for buildings, but our math is fancier. All right, so the convention for personal property is either mid-quarter or mid-year, and you test for mid-quarter first. So the mid-quarter convention, I'll let you read this yourself. The short story is, did we put more than 40% of the property in service during the last quarter of the taxable year? Did we backload our deduction? They don't care why. This is just a math test. And then remember, it's the aggregate basis. So all makers' property other than buildings, because buildings are mid-month, 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 placed in service in the last 3 months. For us, that will always be October, November, December. We will not have any fancy fiscal years. And note that if you buy it and sell it in the same year, you're not entitled to any depreciation. Remember, because you lose a half a year in the year of acquisition, you lose a half a year in the year of disposition. And if they both happen in the same time, you have not any year left at all. So if I buy and sell in the same year, it just doesn't play a role here at all. So this is all property other than buildings. And it's the line 19 or table depreciation amounts. And we'll cover that some more in class. All right, just a quick reminder that you can find the same information on both your checklist and your chart. So when you get confused, you can slow down and start reading again inside your depreciation packet. Okay, this is the same part 3 of the 4562 that we looked at when we were talking about buildings. I forgot to draw your attention to the fact that if you read Section B, line 19 is only being used for assets placed in service during the 2013 tax year. Items that you placed in service in prior years, you're going to give one number to the IRS, and you're going to put it on line 17, placed in service beginning before 2013. You do not provide any depreciation calculations with your tax return, although you clearly have to have them for your records. Right? The IRS publications have some suggested formats. Most people will use some sort of Excel spreadsheet or pre-purchase software package to keep track of these things. So we're on 19. We're primarily interested in B, 5-year property, and C, 7-year property. Those are referring back to those recovery periods. So if it's a car, it's classified as a 5-year recovery property. If it is an office machine, it could be 5-year. If it's a backhoe, it's probably 7-year. But you could look those up if you had to. But I am always going to tell you the recovery property. And then column B, month and year placed in service, is all blotted out. We're not going to separately record. We're going to put all of our 5-year property together as a single number. So all of our 5-year property, and in fact, all of our property on lines A through F will either be half year or mid-quarter. And the test for mid-quarter is down there at the bottom. Remember, we're testing everything except for buildings. We're putting our October, November, December acquisitions on the top, dividing by total acquisitions for the year to determine whether we have mid-year or mid-quarter. So in that column E where it says convention, it is not possible to have half year for 5-year property and mid-quarter for 7-year property. They all have to be the same. So column C, my cumulative basis for all my 5-year property would be on 19B, reduced by any reductions I took for number 2 and 3 on the checklist. And once again, the recovery period is either going to be the class life or the recovery period. The convention will be mid-quarter or half year. And then your method will be double declining, 150% or straight line. And then that last column is your actual depreciation deduction. So we're going to do some math. So you've got 2 different ways to approach this. One is to do the calculation of basis times method times modifying convention. And the other is to get it in the appropriate places on the tax forms. And I'll be grading both efforts separately. So make sure that you focus on what's being asked. The half-year convention applies if the mid-quarter convention does not apply, right? So here's an example. Your company placed some 5-year property in May and some 7-year property in November. So what's the test? The test is the fourth quarter divided by total acquisitions a ratio that is greater than 40%? If yes, you are mid-quarter. If not, you are mid-year. So when you do this math, the 250 is going to go on top, and the sum of the 5 and 7-year property go on the bottom. And that turns out to be 38.46%, 250 over 650. Double check my math. Make sure you're doing what I'm doing, not just reading it. So it is less than 40%, so everything is half your property. Now you have to separate out, right? Because the 5-year property goes to the 5-year table, and in the first year you use 0.20. The 7-year property goes to the 7-year table, and in the first year I think it's 14.29, but don't quote me on that. Make sure you look it up. All right, here's another example. It's still the same 250 and same 400, but we swap them so that the larger purchase is in the fourth quarter. Remember, our fourth quarter is October, November, and December. So this time it's going to be 400 over the sum of 250 plus 400. And it turns out that that is going to be greater than 40%. So the 5-year property is first quarter, mid-quarter. And what's a little tricky here is the 7-year property is fourth quarter, mid-quarter. And we will go over this again in class. But remember that it is possible to have 8 different classifications here, right? Because you have 5-year property purchased in the first quarter, second quarter, third quarter, and fourth quarter. It's possible to have 7-year property placed in service in each of those individual quarters. If the total acquisitions in the fourth quarter are greater than 40%, then you have to sort everybody out by their quarter, right? There's no lumping together the way there is with 5-year property. This is an excerpt from our tax tables, just the 5-year property. Note that the years go down. It takes 6 years to recover your 5-year property because you only get a half or mid-quarter in the first year. So 5-year property takes 6 years to recover. The big fat column is half-year convention, right? Before you get to your table, you have already tested to see whether it's half-year or mid-quarter by running your math. Remember the formula down at the bottom. Once you've determined that it's half-year property, all you're going to do is stay in that column and move down. You will not use a separate modifying convention because the 20% is 1 over 5 times 2 divided in half with the half-year convention applied. If you are mid-quarter, there's 4 separate quarters. We'll discuss all the exciting reasons for that in the second set of our PowerPoints. For now, just note that it's always a calendar year. For now, we'll stick with fourth quarter acquisitions, which are October, November, December. And then as we build the PowerPoints for the next set of depreciation, we'll talk about how we could land up with both first quarter and fourth quarter properties in the same year. So here's our first example for personal property. 5-year property, I will always tell you the recovery period. I'll tell you the cost. I have to tell you the date it was placed in service. And then I will ask you, what is the cost recovery? Cost recovery is line 22 of your 4562. Unless I specifically ask for a line on the 4562, I always want your final answer, please, pig rows, right? How much can you tweak out of this? So we're going to start at number 2 on the checklist because we don't, number 3 because we don't know 1 or 2 yet. So that's the bonus depreciation, right? Is it new? Is the use qualified life less than 20 years? Is the qualified business use greater than 50%? Those are the parameters that you need in order to be able to take bonus depreciation. If you take bonus, reduce your basis before moving on. Then test for mid-quarter using number 4 on the checklist, right? For any acquisitions in October, November, December greater than 40% of total acquisitions of the year for all property other than buildings. No real estate need apply. And then we're ready to do our basis method and modifying convention. Think about it, and we'll move to the next slide for the solution. All right, I'm going to put the facts back up and the answer. The answer is 15,000, and it consists of two parts. Because hopefully you all decided, because I did not have the word used in front of the word property. It was brand new property. It has a 5-year life, and there is no information here about the qualified business use being less than 50%. Therefore, it is entitled to bonus depreciation. All right. So bonus depreciation is 50%. So our original cost basis is $25,000, but we're going to take 50% off the top as bonus depreciation. That will show up on line 14 of the 4562, and we have to reduce our basis before moving forward. So our remaining basis for the tables is $12,500. It's 5-year, because I told you so. Double declining, because that's what I told you to use, right? Pig rules. And it's half year, because if you run the math, there's 0 acquisitions in October, November, or December, and 0 over anything will be less than 40%. Therefore, it's not mid-year. Therefore, it must be half year. And if you're smart and energy saving, once you figured all that out, you simply went to the tables and used the 5-year half year and got to 20%. Those tables are double declining balance for 5- and 7-year property, converting to straight line when appropriate. The 15-year table is 150%, converting to straight line. And remember, all the tables know that row 1 is the first year, so they have simply built the modifying convention in when you're on row 1. Any other rows, if there is a disposition, you must apply a modifying convention. If you are brave enough to do this stuff by hand and insist on a hand calculation, you must apply the modifying convention to the math. Okay, this is that same property that we had in the last example, but we're now moving to year 3. So when I give you this kind of question, you have to go through what happened in 2013, what happened in the first year. You have to mentally run through the checklist to determine whether or not 1, 2, 3 applied. Number 4 will tell you what the modifying convention was, because whatever it was in 2013, it is the same in 2014. All right? And on our current facts here, it was sold in November of 2003. If I had told you that we held it for all of 2003, the first steps would still be the same. You have to figure out if you took any immediate write-offs in the first year to determine what the basis was, and you have to determine what the modifying convention is. So we did take bonus depreciation in 2013, so you have to use what was left, and this is what I call the table basis, right? Because this is the amount that you went to the tables and multiplied by 20%. So we're going to take that number, and we're never going to decline it. We're going to continue to use it. So you're going to find the percentage in the table for year 3. We never leave our column. So this was 5-year, half-year property. All we're doing is moving from row 1 down to row 3. There was a there was a disposition. We go out the way we came in. It was half-year property when we bought it. It's half-year property now. All right, so now you're ready to do bases. That was what's left after bonus depreciation. Method will be row 3 of your 5-year, half-year table. And your modifying convention is the same convention as it was in example 1. So I'll give you a minute to think about that as I move to the next slide. All right, so here's our facts and our answer. Our answer is a piddly $1,200, much smaller than it was the first time. So your basis, that should have been your $12,005, right? Half of the original basis, because you took 50% off the top. Method is still 5-year double declining balance, and you do need a half-year convention because you sold it, and you go out the way you came in. And the table for row 3 is 0.1920, and a half is just a half, right? 50% divide by 2, whatever you want to do in your calculator, and that should get you the $1,200. Third example, 7-year property, costing $530,000, placed in service on October 11, 2013. What is the cost recovery for year one? All right, so I got to stop and think about it. We're going ignoring 1 and 2 on the checklist for now. So you're going to use number 3 and number 4 to determine whether or not you were entitled to bonus depreciation, and then to determine whether it was half year or mid-quarter. That's what 4 on the checklist does. And once you've answered that, you can go to the tables, because I've told you to use double declining balance. So you're going to use the table in the handout using the 7-year table. So start with number 3. After next week, you'll be starting with number 1 and using number 2 before you get to number 3. So don't get in the habit of saying, I always start with number 3. If you do take bonus, don't forget to reduce your basis before moving on. Test for mid-quarter using number 4 on the checklist. And then you're ready to have your basis, method, and modifying convention. Okay, give it a thought as I move on. There are some 7-year properties coming up, so I wanted to stick the table in here so that you know what you're looking for. The table works exactly the same. It turns out that there actually should be 8 rows instead of 6, because it takes 8 years to recover 7-year property, because you never get 100% in the first year. But this is a nice, neat way to summarize everything on one chart, so we simply won't go past year 6. There's our facts again. No bonus. Everybody agree that word used in front of 7-year property tells us that it is not entitled to bonus depreciation. We don't need to think any further once we know it is secondhand property. Mid-quarter, since everything is placed in the 4th quarter. So the 4th quarter overall would be 530 divided by 530, which is going to equal 1, which is clearly bigger than 40%. So now the answer is going to be 921. Basis, method, modifying convention, that's the money shot. The whole 530 is your basis. 7-year double declining balance is your method. Mid-quarter is your convention. So being clever people, you're going to go to the tables. You're going to find 7-year mid-quarter, 4th quarter column. And for row 1, you should see, it should say 3.57%. which is 0.0357 for your calculator. And remember, on row 1, in years of acquisition, when using the table, that is the final answer, please. That is both the method and the modifying convention put together for you, because the table knows this has to be year 1. So everybody needs to make the same adjustment. All right. A couple more examples. All right, 6 and 7 on the checklist. We've already alluded to dispositions. You need a modifying convention in the year you acquire, and you need one in a year of early disposition. So if I told you it was sold, that is your signal that you need to use line number 6 to determine your modifying convention. So it's always mid-year, mid-quarter, or mid-month. And if you like formulas, you can see the little one I have here. If it makes sense to you, that's fine. If not, find another way to remember how to apply the mid-month, mid-quarter, or mid-year conventions. Number 7 simply says sometimes pig rolls are not a really good idea. We're not going to talk very much about it. I will not test you on this material. Alternative minimum tax requires you to use no more than 150% declining balance. So sometimes people will use 150% for everything, just to cut down the record keeping. And then if you have large losses, you're a startup company, there might be reasons why you don't want to accelerate losses into the current period. So you might want to stretch out your depreciation by using straight line over a class life. But like I said, we're not going to go there. Just be aware that in the real world, you want to make sure you think through what you're doing and not just do knee-jerk calculations, because that's the way you learned it in class. All right, here's our next example. Office building, still non-residential, way back in 2010. This time we paid $270,000 for it, and some of that belongs to the land, and it's being sold. So to calculate the corporation's depreciation deduction, You need to know the bases. This is straight line depreciation, so we're not going to decline the bases. But when we use the tables, we never decline the bases anyway, right? Whatever we decide our basis for the tables is, will be the basis for the entire life of the project. The method, well, it's residential. Do you remember what the useful life for residential is? If not, you have a checklist for that, right? You can look it up. Modifying convention, do we need one? We need one if it's the year we bought or the year we sold. So think about all that for a minute, and we'll move on to the solution. All right, while you're thinking, I'm putting the facts back down here and the answer, 4359. So you should be able to come up with 4359 by determining the appropriate basis, method, and modifying convention. Basis is 240. The price minus the land. It's non-residential, so it's straight line over 39 years. You sold it, so you count back to January, and September is month 9. Minus 0.5, because you always use a half, divided by 12, because it's the mid-month convention, and there are 12 months in the year. Example 4, it is the same property as in example 3, right? The 530 of 7-year, second-hand, fourth quarter, mid-quarter property. And now we're moving to the 4th year and selling it. And now it's important that I tell you what month we sold it in, because remember, this is a mid-quarter convention. On the half-year property, all I have to say is it was sold during the year. Whether it was sold on January 1 or December 31, you get a half. But when it is the mid-quarter convention, you have to count the quarters you actually owned it. For a disposition, that means we count back to January to get our quarters or fraction thereof, and then we subtract by 0.5. And by golly, our denominator is a 4 because there are 4 quarters in the year. All right, so we're going to start with the same basis we used for table depreciation in year 1. And on our facts, that was the whole $530 because we did not take any 1, 2, or 3 adjustments off of that number. But find the percentage in the table for year 4. People tend to jump columns here, right? You're all the way over in the 4th quarter and mid-quarter. People see that month of May and then want to jump over to the 2nd quarter, mid-quarter. But that ain't allowed, right? You must be loyal to your column. Your job in all cases is to move down from the original column and get to the appropriate row. So you want to be in 4th quarter, mid-quarter, 7-year property. And you want to put your finger on that 3.57 and you want to move yourself down to row 4. And then you'll need to apply a modifying convention, counting the quarters or fractions thereof that you owned it during the month. All right. So basis, method, modification. All right. I flipped without telling you to stop and think. So stop and think because I didn't give you any time on the last slide, right? So it's 530,000. Row 4 percentage adjusted by a modifying convention mid-quarter, reflecting the number of quarters if it was sold in May. And here's our answer, 27,944. So if you didn't get that already, stop and think a minute before I blow this down. Basis is the whole 530. Method is row 4 of your table. And the modifying convention, that might be a little tricky. May is in what quarter? Count the number of quarters from January to May, including fractions thereof. Subtract 0.5, divide by 4, because there are 4 quarters in a year. All right, so 7th year, double declining mid-quarter. The table was 1406. The quarters were 2 because May is in the 2nd quarter. Doesn't matter whether it's the first day of the 2nd quarter or the 90th day of the 2nd quarter. You write down the number 2, and then you take away a half of the quarter, and then you divide by 4. All right, so it's 2 because it was used in 2 quarters during the year. All right, here's our last example. I made one change, the word in red. All right, it's still a 530. We're still selling it in year 4, but it was sold in November. So that means our basis and method will be the same, but our modifying convention has to count a different number of quarters to apply the modifying convention. So this time the answer is larger because we owned it more of the year. We got credit for more quarters. So basis, method, modifying convention, still 530, still 1406. This time it's 4 because if we sold it any time between October 1 and December 31, we're going to get credit for 4 quarters. And then we're going to dock ourselves 0.5 because it's a half quarter convention, and then divide by 4. And that gives us the 65,203. So just a few closing comments. This is difficult material. The sequential nature makes it important that you do practice. If you don't try problems, it is very likely that you will stumble and get confused when you come into the group in the mini quiz. So there are some problems in the textbook that are pretty directed that tell you to do this or that. Then there is a depreciation practice set on Blackboard, which requires you to go through the checklist. I don't tell you, now take bonus depreciation, now do this. Remember that we have not yet covered number 1 or 2 on the checklist. So the jargon listed property, that would be any problem where the qualified business use is given as a percentage. That's an indication that number 1 on the checklist needs to be listened to. Limited expensing is number 2 on the checklist. So if you get to a problem and they have taken some numbers off the top before they multiplied by 50%, that's an indication that we've done the limited expensing. It's not overly complicated. That's part 1 of your 4562. You could always start it if you're comfortable with the rest. Just go step by step and you'll be careful. So Mickey tax return 8, I have the basic facts, and then there are several alternative calculations. Just do the first set of facts for your tax return 8. I will have an Excel spreadsheet out with all the rest of the solutions when Mickey is due. So if you try them, you have that much more practice under your belt. Remember, this is definitely an area where you need to practice. You need to be in control. You need to pay attention to the nuances. It's a small amount of material, but it's tricky. And so you need to be careful if you're going to be successful.